Hey everyone, welcome back to the channel. So in today's video, I'll be walking through a live trade which I took using implied fair value gaps. So this setup has formed in New York PM session. So I will show you exactly how I identified the implied fair value gap and what gave me the confidence to do my stop management and hold the trade. So before going into the concept, so I just want to establish the context. So this is a 1 minute chart. This trade was taken on 22nd October 2025. So you can see this PM session first presented fair value gap formed after 1:30 p.m. So you can extend this first presented fair value gap formed after 1:30 p.m. You can see when price came back into this zone, into this first presented fair value gap, the bodies of the candles never closed above 50% of this first presented fair value gap. So this is the first indication, guys. The next thing is you can see a rejection from here. You can see the price rejected from this first presented fair value gap and came back into this quadrant level on the daily chart and went back up again. The bodies of the candles again failed to close above 50% of this. Now you observe this part of the price action, this rejection from this first presented fair value gap. So you can see this was the rejection and you observe this candle, this wick, this huge candle and this wick. So though we don't see any fair value gap inside this chart, so whenever there is a huge candle which is engulfed with at the both sides, whenever a huge candle which is engulfed on the both sides with huge wicks, this is where the implied fair value gap forms. So if you go to the next slide, so you can see, so you need to plot 50% of this wick and 50% of this wick and extend through. If you extend these 50% of this respective wicks, you will get implied fair value gap. So whenever price comes back into this implied fair value gap, you can see some kind of reaction. So this was the logic behind my trade. So this was the first presented, this was the first implied fair value gap. And similarly, this was the first fair value gap plotted in the previous slide. Similarly, when we had this rejection from this implied fair value gap, you can see the bodies of the candle never went above this, never went into this fair value gap, only the wicks went, but it did not even cross this implied fair value gap. So similarly, if you see this huge candle, again this candle is engulfed with both this huge wick and this wick. Again, if you plot 50% of this wick and 50% of this wick, and you have if you extend this 50% levels to the right side of the chart, again you can see in the future price action when price came back into this implied fair value gap, we had a beautiful reaction from this. So here I'm just sharing a screenshot of the trade I took using this logic. You can see this was the first presented fair value gap. I did not highlight here, but you can see price came back very close to my stop loss and then it went towards my target. So just to recap again, so you don't visually there is no fair value gap inside this price action, but whenever any huge candle, we have huge wicks on either side of the candle, then you need to plot 50% of the wick, 50% of the wicks on either side of the candle like this, and just you extend those 50% levels to the right side, you have your implied fair value gap. So whenever price comes back into this implied fair value gap, you can expect some kind of reaction. So I'll just play the trade which I took. It's just small scalp. using this concept.